Well, stocks rose to new record highs last week after a stimulus bazooka from China followed the Fed's 50 basis point cut a week prior, while the dollar continued to face headwinds and the Treasury curve continued to steepen. A busy week now lies ahead as the final quarter of 2024 gets underway with a packed data docket lying in wait, including the latest eurozone inflation figures, a plethora of PMI surveys, and of course, Friday's all-important US labour market report in the mix as well. Another busy week and plenty for myself and Ryan Littlestone to discuss on the show. So without further ado, let's crack on with things. Well, we're moving into the fourth quarter of 2024. I'm not entirely sure where the last 9 months or so have gone, but with me once again to try and make sense of everything is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good afternoon to you. It feels like time is absolutely flying by at the moment.
Yeah, it does seem to go pretty quickly when you get to my age, particularly. This year's absolutely flown by. I can't believe it. It'll be Christmas soon. I've seen you already started moaning about the Christmas headlines popping up.
Well, I did get an email today, bearing in mind we're filming this on the 30th of September. I got an email that landed in my inbox saying Boxing Day is coming. Now, I mean, yes, it is coming, but, Easter is coming as well. You're not going to advertise that already, are you? It's, the commercialization of Christmas, isn't it? It's not right. But before I get too far on my high horse,
I knew that would kick you off into a rant. That's why I dropped it in there.
just stirring the pot as usual, aren't you, over there?
Yep, absolutely.
Right, well, why don't we roll the titles for Topical Thunder, and I'll get off my high horse in the meantime. So first things first, this week, I want to take a bit of a step back because the last kind of week or two, I guess 10 days, have really seen a bit of a clear message coming through from policymakers, mainly on the monetary side, but also on the fiscal side as well. And that is that we are getting close to the point where economic pain thresholds are very, very close to being breached. Now, of course, the Fed kicked things off with a 50 basis point cut a couple of weeks ago, trying to get ahead of any potential economic weakness amid their forecast for a more substantial rise in unemployment and a faster return to the 2% inflation target. Last week, we had a whole host of measures coming out of China, this bazooka-like stimulus that I mentioned, far too many things to go through in this segment, but the main measures included a 20 basis point cut to the required reserve ratio with a pledge of further forceful cuts to be delivered in the future, liquidity support as well to try and fund equity purchases, and also some capital injections into some of the major Chinese banks amid a whole host of other policies too. But it's not just the Fed and the PBOC that are delivering stimulus, it really is a global phenomenon at this moment in time. The Bank of Japan, they have started to adopt a marginally less hawkish tone in noting that upside risks to their inflation outlook have eased. In terms of the ECB, we had sources reports last week noting that the October meeting is wide open. And of course, this comes as data in the eurozone deteriorates rapidly. The composite PMI falling to an 8-month low in September. And just as we started the show, we had ECB President Lagarde saying that they are now more confident that they will hit 2% inflation in a timely manner, and that they will take that confidence into account at the October meeting, pretty much cementing that they will deliver back-to-back 50 basis point cuts. We then had dovish guidance from the Swiss National Bank last week. They were saying that further cuts are necessary in the coming quarters, and that's interesting because they've already got rates as low as 1% and are getting very, very close very quickly to that effective lower bound that every policymaker and his dog swore off going near again. And then the Riksbank last week cutting rates by 25 basis points and saying that 50 basis point moves are possible. So the direction of travel for me is pretty clear at this point. Rates are naturally on their way back to a more neutral setting and seemingly in relatively rapid fashion, not only in the United States, but also elsewhere. And again, we see policymakers showing their ability and their desire to step in and prop up the economy as conditions sour. And what this is the policy put in action. It's something we've been talking about pretty much all year, and it's something that remains as forceful as as ever as we go into the last quarter of the year. And I think it's important to remember that, fighting this sort of thing, fighting this bonanza of central bank stimulus is something that seldom ends particularly well.
No, you're absolutely right, Michael. But I think there's a good point to be made here and a good lesson to learn that nothing really matters unless the Fed start moving. I mean, we've had the Bank of Canada, they've cut 3 times now. The ECB have done a couple. The Bank of England started cutting. The Riksbank have already been moving. S&B have already been moving. A lot of banks have already been cutting their rates, but it's not until the Fed start moving that the market really sits up and goes, oh, actually, we're in a cut phase now. It's a strange phenomenon, but it's something nonetheless, because we really haven't seen the dollar moving, yields moving until the Fed really got close to that cut, and whether it was going to be a 25 or 50. So there's a lesson there when trading central banks. Nothing else matters unless it's the Fed in large part. But moving on from that, we're in this situation. We knew it was coming. It's finally here. A lot of banks have already started. They want to get rates down to neutral. And again, as I said last week, doesn't matter what the data does unless it really significantly goes against these central banks. They're going to keep cutting. So even good data doesn't necessarily mean they're going to stop.
No, absolutely. And I guess, that leads quite nicely onto what you were going to mention, which is, the idea of rate cuts, and particularly your China position last week.
Yeah, not a good position, that one. But all these rate cuts, is it a bit of hopium, or is it actually a panacea to what's going to happen with growth? And that was perhaps the most surprising reaction from markets, that all this easing has seen the sort of risk on switch being flicked. Especially after the PBOC move. I had it in my setup last week. I was certainly expecting the yuan to weaken on all that easing. Funny enough, I said it in the show, we probably waiting for a big load of kitchen sinks to be thrown, and that very afternoon they did exactly that. So we got what we were thinking about. I took a loss on my dollar China longs on the back of my expecting the yuan to weaken, and instead it strengthened and has just kept strengthening all the while, where even the dollar was falling and we got the Fed cut. So the market has taken all this easing as a bit of a signal that it won't just stop economies weakening further, but will perhaps instead actually bring a bit of a growth spurt, growth roaring back. And you only need to look at commodities like copper, which I'm going to do so in a bit, and the moves in commodity FX to see that. Now, the problem is it's going to take a while for all these rate cuts to be felt and whether they do actually spur growth. So I think some areas of the market are perhaps running a little ahead of themselves in some of these moves. China may have gone hammer and tongs, but it's still got those geopolitical issues with the West affecting trade and foreign investment. As mentioned last week, other central banks like the ECB still have to keep control of the inflation genie and stop it from going through targets. Spanish, French CPI last week showed that problem might be arising already, as both numbers dropped below the ECB target by some margin. Italy year-on-year CPI is now 0.8%, well below target. And Germany also saw a big steep loss today in their CPI numbers. So long story short, I think the risk-on brigade are going to, they're going to find that reality isn't going to conform to their thinking right away. So there's a risk for perhaps some strong pullbacks in some of these risk assets. But if we do start seeing data like manufacturing picking up, expect the risk rally to continue and maybe build up a bit of steam.
Yes, I think there's more chance of pigs flying past the window than manufacturing activity picking up at the moment. But you're absolutely right. It is something that's worth paying close attention to. And I think this is where some of the moves that we've seen in the treasury market of late have been of particular interest. You look at how the curve has just relentlessly bear steepened. Apart from over the last couple of days, we've seen the 2s10s flatten by a handful of basis points. But there's really aggressive bear steepening across the curve since the Fed delivered that 50 basis point cut. It just seems like the market is sending a little bit of a message that there is a degree of concern out there that we may be seeing too much easing too quickly into an economy that at its core remains relatively resilient and, of course, has inflation continuing to run north of that 2% target. I think we're dealing with two very different sort of kettles of fish, for want of a better word. The US economy is still very, very strong indeed. the eurozone economy, you're looking at, well, the CPI figures we got out tomorrow. You would imagine that they are going to show headline prices back at target, and then of course you've got the pretty disastrous growth data as well. So I think it is a bit of a different equation on either side of the Atlantic at the moment, but there is certainly some risk out there, and the market is pricing that, that things are moving perhaps a little bit too rapidly in terms of policy easing.
Yeah, and that's always going to be the way, because the market always gets far more dovish over economies and central banks than they do when they need to be hawkish. But it's a complete flip around. You know, the data at the eurozone, you suggest they should be doing 50s instead of the Fed, and the Fed should be doing 25s. But here we are; they're their own bosses, and they ought to make the decisions.
Indeed, yes, and that's why they're paid the big bucks. But speaking of the Fed and whether they go 25 or 50 next time out, one of the key determinants of that will be the labour market. And of course, we get our next read on the health of the employment situation in the United States on Friday with the September labour market report due. We have seen a little bit of a pairing in the odds of a 50 basis point cut at the November FOMC meeting. The market now pricing in around a 1 in 3 chance of another jumbo cut at that meeting, down from about an even chance that the market was seeing towards the back end of last week. But nonetheless, it is still the case that the report has huge significance for policy. The FOMC have explicitly told us, and by their actions they've implied this as well, that they now have sufficient confidence in inflation returning to that 2% target over the medium term. And as such, it is the employment side of the dual mandate that is now going to be the main determinant of policy changes going forwards. In terms of our expectations for the data, headline non-farm payrolls, they're seen rising by 140,000 in September, which is broadly unchanged from the 142,000 pace that we saw in August, although we are, of course, pending revisions for that August data. Unemployment, meanwhile, that's expected to remain at 4.2%, with participation also set to remain unchanged at 62.7%, pretty much where it's been for the last 12 or 18 months. And earnings, meanwhile, are expected to have risen by 0.3% on a monthly basis, down from the 0.4% that we saw in August, which would, though, leave the annual pace unchanged at 3.8%. My base case is that from here on in, the Fed deliver a 25 basis point cut at every meeting. But if we see any further labour market weakness, then they will deliver a 50 basis point move. And I think that reaction function has been telegraphed pretty clearly from what Chair Powell had to say during the post-meeting press conference after the September policy decision. Now, the question then becomes, what counts as material or significant labour market weakness? Well, in that respect, I would say we need to look at the summary of economic projections, whereby we see the FOMC forecast unemployment at 4.4% both this year and next year. Therefore, you would say if unemployment is below that 4.4%, 25 basis points it is. If unemployment is above that 4.4%, obviously these forecasts will be revised, but at least until December, then you go back to talking about the possibility of 50 basis point moves. And I think in terms of the market implications for the jobs report, Ryan, I'm keen to get your view on this. I think it's going to be very much a case of good news is good news and bad news is bad news for risk, with the focus for equities being primarily on the macroeconomic implications of the jobs report, rather than any potential that a bad number has for sooner and greater policy stimulus in the form of a larger magnitude rate cut.
Yeah, well, I've yet to see a situation where good news is bad news and bad news is good news. So you're probably right in your summarisation on that one. Yeah, it amazes me. You can guess the Fed path for rates over the months ahead, but you won't give us an NFP number until 5 minutes before it's due to drop.
Hour and a half before, midday Friday, as always.
Yeah, I'm just getting my monthly moan in like you do. I think the Fed may be a little bit too tight with that 4.4%. It doesn't give them much wiggle room, but as we said, they're their own bosses and they set the numbers. So you're absolutely right. This will be just about right, considering the data we've had since the 50-bit cut, that we get a really strong jobs report, maybe unemployment 4.1%, and wages up and a nice 250,000 number on the headline. It'll be just about right considering the data. So the NFP, it's always a coin flip. It's always a lottery. That's why we love it. We used to love it on the live floor. It was the biggest number of the month. The whole pit's absolutely packed, shoulder to shoulder. And it's just an absolute lottery, and that's why we love it. So I think you're right. But as I said, even if it's a good number for trading it anyway, if it's a good number, unless it's really, really hot, the market's probably going to wash out some more of those 50 pip cut expectations. We'll see dollar rally, yields rally, but I don't know how long that will last for.
Indeed, we shall see. Only time will tell. Ryan there taking us back to during the war, black and white television, rationing and all the rest of it. Hopefully you can bring us back to the present day, because there's plenty of economic data to get through this week.
Oh, you're such a cheeky sod. I'll tell you what, when we meet up for lunch,
really worried where that was going.
Yeah, exactly. Nearly. Got to keep it clean, folks. It's kids watching. Right. Anyway, there is plenty other economic data coming out this week before we get to Friday's non-farm payrolls. So I'm picking out the choice numbers that we need to watch. Tuesday, as mentioned, we get all the manufacturing PMIs, some fresh, some final numbers culminating in the ISM in the US afternoon. And as mentioned in my last topic, these will be the big numbers for the risk trade, these manufacturing numbers. The ISM is expected to remain in contraction, but improve mildly to 47.6 from 47.2 previously. After that, we get the pan, or before that, we get the pan eurozone flash numbers, CPI numbers now. Given again, as mentioned, some of those country numbers have come in a little on the soft side and missed expectations to the downside. The market will be looking for a softer number already. We're expecting 1.9% in the headline number, which is a bit below the target. Well, I say target, the ECB mandate is below but close to 2%. So they've got some wiggle room there. The all-important core number expected to come down 1 point to 2.7%, still quite sticky. Later on in the afternoon, we get the JOLTS numbers. They dropped significantly last month, and another print like that will play into the weaker jobs theme ahead of Friday's NFP. Wednesday's fairly quiet, but we obviously get the NFP appetizer via the ADP number. A pickup of 124,000 is expected there versus the 99,000 prior. I can see Michael shaking his head at the mention of that data again. Anyway, Thursday is Services Day. We get the ISM. Again, watch closely for activity, prices and jobs. Those are the three metrics you really need to be watching there. The service sector has obviously been the more dominant sector for many countries, so this could be a big mover for those rate expectations, and thus a big market mover in prices. The ISM is expected to improve just by a small pip to 51.6. Now, another jobs number I like to keep an eye on is the Challenger grey layoffs number. That is good just to see what trends are developing. Now, last month, the report said that hiring fell to the lowest since the survey began in 2005. A lot of last month's job cuts were attributed to cost cutting, market and economic conditions, but also AI was mentioned for the first time since April. So no doubt that will increase in the future. It's a very fine line for jobs. All we've heard is that hiring has been slowing. Okay, we've heard that from Fed members, we've heard that from businesses. It's a fine line between hiring and firing. And if we ever make that switch into firing, i.e. negative numbers in FP, then I think the market's going to throw a bit of a paddy and we'll see those 50 pip rate hikes calls increasing markedly. So unless you've got anything else to focus on, Michael, I think that wraps up the data blast for this week.
No, I don't have anything else to focus on. One thing I certainly won't be focusing on is that useless ADP report. I actually ran the numbers on that this morning. I was writing up my non-farm payrolls preview. It's on the Pepperstone website if anyone wants to have a gander at it. And the correlation, the R-squared value between the ADP and the NFP number since the start of 2023 is, I think it was 0.17, 0.18, something like that, which for those of you out there who are not statistical nerds, a number per zero is no correlation whatsoever between the two variables. So there is literally no relationship between where the ADP number prints and where the non-farm payrolls number falls on Friday. If you're using that to predict things, then go and give your head a wobble. And now look what will happen. It will probably be bang on the money this week. Now I've said that will make me look like a fool.
Well, you may not like it as indicator, but it moves markets, and there's nothing else to trade before the NFP in terms of big numbers like that. So it is what it is, mate, and we'll just trade it whatever happens.
Indeed, we shall see. Right, let's move on to some charts in That's a Setup. Just thinking, the perfect way to annoy me now. You just put one of these as like Elliott Wave on the ADP employment number, and you just end up making me walk off my own show. Right, thankfully, we are not looking at that this week. And what I am looking at is the NASDAQ, because the path of least resistance continues to lead to the upside for the US equity complex. Those three prongs of the bull case, strong economic growth, solid earnings growth, and the forceful Fed put are well and truly alive and in place at the moment. And it was perhaps no surprise to see that the tech sector outperformed last week, particularly amid that stimulus that was delivered out of China. It does look like the market is trying its best to make a fresh record high, which comes in just shy of 21,000. Now that we're north of the 20,000 mark, although we have seen a little bit of selling creep in as the new trading week gets underway. I still think that dips are there as buying opportunities. And if you are of that ilk, then the 100-day moving average crossing over the 50-day moving average is perhaps another bullish sign to add to that checklist. I think the payrolls print is obviously the key risk to keep an eye on this week. I would be surprised, as we were just touching on earlier, if the market is particularly perturbed by a strong print, particularly as that would imply that the economy remains resilient. And I think that the bull case is still firmly intact for US equities, and the NASDAQ taking a little bit of attention this week, given its outperformance last week. We'll see whether that can continue, but certainly a rising tide should continue to lift all boats on Wall Street.
I'm going to contradict myself now, because stocks is one of those assets where bad news is good news for them anyway, and the trend does continue, as you say. We've got a lot of stock market, well, the S&P and some of the others, they're just holding close to highs, having had fresh highs last week, not managing to build on them. So the NASDAQ is, probably lagging a little bit behind at the moment, but the direction is clear as you like. It's, that chart is probably an Elliott Waves dream. We've got different waves in that one, but not that I know about it. But we had that first high, we had a pullback, then we had a rally, then we had a pullback, didn't quite get down to that prior low, and we're moving on up above the prior high. So, there's no reason why this shouldn't carry on to all-time highs, but we're going to be driven by the data this week. And as you say, if it's good news in jobs and market, then stocks get a shot in the arm. If it's bad news, then they probably go up on the easing factor anyway. So I still can't see any reason why they go down, to be honest with you.
Indeed, and actually, just on that, I don't think we've got a chart of it, but the DAX over in Germany. Great example of how bad news doesn't impact the market and how the stock market is not reflective of the economy. Incoming news on the German economy pretty much could not be worse at this point. The government are now set to forecast complete stagnation in GDP this year as a result of how dismal their economic performance is. Where's the DAX trading? At a new all-time high. I mean, I think that pretty much says all you need to know about how strong the bull case for stocks is at the moment. Anyway, moving on into the FX space.
Yep, going to move on to the euro for this one, and this 112 is really being a tough nut at the moment. And now, first, I have to admit, getting a bit lucky with this one last week. I've been long from 110 and slicing and taking profit all the way up to 112. And I thought I'd run a buy stop above 112 last week, 112.15. Last week's high got to 112.14 before it turned right around. So we haven't managed to hold a break over 112 yet. So I was lucky not to be triggered and flipped on that trade anyway. The more times we resist this level, though, the more likely a further break might carry on through. I suspect the stops are getting bigger and bigger through probably 12.10, 12.20. We do have end of month in the meantime going on, so there's been a couple of tests already today. And if we're going to break it, I want to see it break under its own steam, if you like, rather than any temporary factors like end of month fixes. But in the meantime, we're not dipping too far from the level, which does keep the pressure on it. Thus far, dips have been bought up in the mid to low 111s, and it looks like it's going to take a break below 111 to clear out a lot more buyers from this phase in particular. Now, the euro has been a bit of a currency in flux, hence one of the reasons why it's not breaking this key level like some other pairs, like Aussie dollar, if you like. While it remains strong versus the dollar, it's been weaker versus some of those commodity currency moves I mentioned earlier. Plus, with the ECB expectations now hotting up and almost a done deal, there's further reasons why we might struggle to see further significant upside in this pair. This week will mostly be about the Fed, so it's going to have to be the dollar that does a lot of the work here, be it weakening and taking us through 112 or strengthening and taking us back down and maybe through 111. So for trading it, there's really three opportunities. You play the range 112, 111, 110, play the breaks, or even play both.
Yes, indeed. Although I must admit, I have learnt my lesson from the last time I was trying to call levels in euro dollar, and I'm not going to do it again. Instead, what I'm going to do is effectively turn that chart completely on its head and look at the dollar index, because of course the dollar index is 58% weighted towards the euro. And zooming out, we can see that we are getting tantalizingly close to the bottom of the range that we've traded in for the last couple of years, which has been between sort of 99.5 to the downside and 107 all the way to the upside. Those lofty levels are certainly a long way off at the moment, and it does seem that the market is still in this mood of fading into any dollar strength that we do see. And I think generally speaking, the theme within the G10FX world has kind of changed from one earlier in the year where we had sort of two strategies that were working. The first was obviously carry in a very, very low vol environment. And the second was buying growth. And that's why we saw the dollar trade relatively well in the early half of the year. Since then, the market's become increasingly focused on which central bank is going to return to neutral the quickest. And of course, given the 50 basis point cut delivered in September and the potential for further such significant moves as time progresses, the Fed are looking likely to be at the front of that queue in returning rates back to a more neutral level, and the dollar is bearing the brunt of the market's ire as a result. In terms of levels to watch to the downside, were the selling pressure to persist, of course, 100, just the round number, stands out as a key psychological marker to keep an eye on, and then that 99.60 level, which if we get a break is going to be an absolutely huge level to keep an eye on, because that could be the catalyst for a further kick lower if it were to happen. So that's how I'm looking at the dollar. I'm very much in a sell dollar strength mood rather than a buy dollar dips mood at this moment in time. Oh, you seem to you somehow muted yourself, which I must say is a marked improvement, but probably not much fun for our viewers.
Yeah, sorry, I nudged me mute button. I was going to say I'm a little bit on the other side. I'm a bit more of a dollar dip buy, but it's very selective. I'm more likely to be a bit of a dip buy in dollar yen at the moment than I am anything else. But yeah, I thought the level for me here in the Dixie was sort of 150-ish, just amongst those prior lows you can see going back to late August, coming into September. I thought that might have been a bit of a catalyst, but that euro holding that 112 has probably put the brakes on. And what we're seeing with this sort of dribble lower in the index is probably some of the other pairs, gaining against the dollar rather than the euro itself, because it makes a change to have some of those other basket pairs doing a bit of driving. But yeah, this could continue to dribble lower, or like you say, if we break that 99.66 area, 60 area, then it could be a bit of a catalyst and we see a far steeper fall. But I still think it's going to take some really bad data to get us going there. If it's just soft landing numbers, a little bit weaker, not too weak, a little bit stronger, then I think we're just going to continue this dribble, if you like, lower in the Dixie.
Well, there we go. They say it takes two to make a market, and so it would seem. Right, moving on. If you use one of my most hated phrases in financial markets, I'm going to be very unhappy in this next segment.
Well, I think I know what it is, which is why I haven't used it, because I'm in the same boat as you. Is it the medicinal term? Is it?
Yes, it is. Yes, yeah. That one.
I knew it. I thought about putting it in there because I knew it would wind you up as well. But I've already got you early in the show, so I won't wind you up twice on one show, particularly your own show.
How charitable.
Yes, but yes. Well, we need it at Christmas, aren't we, Michael? And copper, it's really the barometer for global growth, and we're talking about the hopium trade, and copper's really been the poster boy for it at the moment. We've seen obviously a big rally since this Chinese stimulus packages were announced, but it's yet another asset that's going to need that hope matched with increased demand, something that's not quite there yet. As usual, we got producers talking their books about potential shortages. The latest was Antofagasta telling us that the world would need to produce the equivalent of Chile's entire production over the next 10 years, or the energy transition would be delayed. And a lot of us are probably hoping that happens anyway. Either way, for the short term, the asset will be a good gauge for risk and how rate cuts are manifesting in economies. We're on quite a big level here, 468, 470, one which we haven't managed to stay above for too long. So this could mark a bit of a stretch point for the stimulus trade. But if we do start seeing some results from the data, we could be heading much higher. If this level holds, it could be a reasonable short-term short, which might then develop into a more medium, long-term dip buying long if the data obliges due to those rate cuts. So might have a bit of a top in play at the moment, but I think if those rate cuts produce miracles, then it's going to be a dip buy.
Yes, we shall see what happens there. I'm very glad you didn't use the medicinal reference. It does amuse me that we had Anto out with that report last week. BHP had a similar thing out. I think it was this morning, saying that there's massive copper shortages and all the rest of it. Just take 5 seconds and Google who owns the world's biggest copper mine, and you'll very quickly see why they are writing those reports. I think the other thing I would say is, particularly on the stimulus we had out of China last week, if you look at the measures, they're all very much geared towards supporting the market rather than supporting the economy. The stimulus is going to do nothing to get China out of this debt deflation loop. It's not going to solve the serious structural demographic issues that the Chinese economy is grappling with, and it's not going to be a sort of magic silver bullet for the manufacturing sector either. So perhaps some of this euphoria is going to fade as time progresses.
Yeah, that's exactly what I'm expecting as well. So there we go. See, we agree on something at last.
Well, indeed. There we go. We're back on the same page. Right, let's move on to our plays of the day. Okay, so I'm looking, staying in the commodity space and looking at crude this week. It was another, I'm losing track of the number of times I've had to say this, but another case of buy the rumor, sell the fact for both WTI and Brent last week. We had a bit of a weather-induced spike, which was helped along by another dollop of geopolitical risk coming into the market. And both of those then faded relatively rapidly, with the market taking them in their stride. We also saw that stimulus out of China having relatively little effect. And as we just discussed, the macroeconomic impact of that is likely to be relatively limited. So my view on crude remains the same as it has done for quite some time now, in that I continue to prefer playing things from the short side. I think any upside needs a sustained pickup in demand, which remains very, very elusive indeed at the moment. And if we were to get a closing break below this 67.70 region, where we ended the day on Friday, then I'd be looking down towards 65, and then the 2023 lows around $64 a barrel as levels to the downside at which to perhaps take profit on that position. So short crude is what I'm looking at this week, and I would say that even the Saudis might be on my side, as the reports circulate that they've given up on that $100 a barrel Brent target. Ryan, the treasury space for you this week?
Yeah, back on this one. And a few weeks before the Fed, I was talking about 2-year yields in one of the topics here, and saying that they were quite high, considering the Fed were about to embark on a cutting phase and looking to get rates down to a neutral level. That's when we were trading around 392-ish. And since then, we've dropped close to 350 and have hovered around there since. It looks like this is where those yields want to pause, and so it won't be surprised to me to see a bit of a bounce here, the market taking that 50 cut in its step now. From here, I think any upside move in yields to 375, 390, that sort of area would be a dip to buy in price, unless the economy or inflation heats up significantly. Rates are still coming down. So I think any rallies in yields, i.e. a dip in price, is a dip to be bought. So that's what I'm looking at for this week.
Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as always. Hopefully, you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets and if there's anything you'd like us to discuss next week. And I'm sure it's going to be another busy show next week, reflecting on the jam-packed calendar of events that we've got to get through over the next 4 or 5 trading days. Until then, have a very good week ahead, and we will see you in a week's time. Thanks as always for watching, and goodbye for now.